Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
So let's start with inflation. When I've done these live events for the past 2 years, we have gone around and spoken to audiences like yourself and asked them about their own experience of inflation on the ground, the consumer's experience of inflation. I think after this long period of doing these, suffice to say, the experience of inflation is very different from the headline that we're seeing. We know that consumers are hurting. We know that what we're seeing, what I mean by stealth mode, this headline here around America's sneaky inflation culprit. We know that services, that there has been, but even before we start looking at airlines, that it has been steadily creeping upwards, most of this driven by labor. So even though the headline inflation seemed to be heading down, the consumer's experience would have suggested otherwise. They were certainly experiencing that. And that was what I got from, I'm not even going to put the question to this audience because I'm just going to take as a given that we all have experienced higher grocery prices and that is starting to, we're all noticing that. What I think is interesting, though, is just how the inflation picture started to change since the December meeting from the Fed. We saw that their expectations, if we look at the blue line for 26, the red line for 27, we could see that as the meetings moved forward closer to the present, we saw that GDP is now turning upwards based on the economy being relatively strong, but still not looking particularly positive for as we go out for 2027. It's certainly lower. The unemployment rate being lower, that's again a factor of the massive AI, whether they're AI driven or not, but the massive layoffs that we've already been seeing, as well as not being able to really trust many employment numbers at all. And then when it comes to core PCE inflation, this is important. The Fed is clearly expecting inflation to rise. So this is the core number. And then, of course, we know with oil that there has been this rise in that. So what has this been driving then? Well, really, in terms of volatility, this has been translated into more volatility on so-called safety assets. So looking at, this is just a Bank of England gilts, they've been trading at levels not seen since 2008. Even the Liz Truss debacle at the end of 2022 did not see rates hopping to where we are here. So government bonds are clearly now starting to look a lot more jittery, not just in the UK, but across the different markets. And so there's clearly a sense that, is this a safety asset any longer as we look at government bonds? I'm going to just move this so we can see the title a little bit. So why, we both mentioned energy prices. Why do energy prices matter? Well, clearly it is a non-discretionary part of expenditure for most consumers, particularly those on the lower left side of the K. And we know that the more they spend on gas, the less they have to save. So this is all, if we were to do a vibe check in terms of the consumer, all of this would translate into a much more challenging environment for the consumer. Then moving on in terms of stagflation, and this is where I will stop to ask for some feedback from you all. One of it's clear that I'm based in the UK now, and stagflation has been a headline in the UK for years, essentially. The problem in the UK was it did not have this resilient economy that we were seeing in the US. We did not have the base of that growth, the underlying. We did know we still had inflation. And in the UK, inflation was definitely starting to had not receded to the same degree. So stagflation was becoming commonplace as a condition. I know that Gerald has written about stagflation many times on LinkedIn. And the question that came up for us was, well, how do you insulate a portfolio against stagflation? You might be able to maybe build in inflation hedges. You might be able to clearly have a growth, that we're in a boom or a Goldilocks situation. Your growth assets will take over. But what is it that the stagflation would mean? And the reason before I just move on to that, what I think is important is to look at the safety trades. If you think in a traditional recession, safety trades are likely to be your hedge and be your protection. What we can see, and I already showed the government bond chart, that has not been behaving like a safety trade. Gold has had its worst sell-off since the bear market in 2013. It has clearly taken a big dip since over the outbreak of Iranian tensions. And it is actually, I thought this was an interesting chart, suggesting that even gold was in a bubble as it was behaving like NASDAQ in the dot-com era. So if our safety trades are not exactly looking like safety trades, any thoughts on whether stagflation is something that we can actually factor in if it is stalking out there? Is there anything in a portfolio that can accommodate that?